you flick on YouTube Shorts or TikTok Shorts, assuming your algorithm hits you for like personal investing, which has got to be most people or a lot of people, it's just everyone goes on about this, just buy the S&P index. If you're getting that every day and that's all you ever hear, then by de facto, people all used to put their money into real estate, and now it's like just put it into an index. It's very easily accessible, very liquid. That could change just the whole historical structure of charts. Hi everyone, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, joined today by the usual Martha, James and Vincent. Just a couple of things before we start. One, just want to remind you for the last time about James Brody's Macro Monday. That's obviously going through macro trends analysis, and that's doing quite well on its first few episodes, and please check that out. Also, we have launched a website called onyxhub.co, so www.onyxhub.co. That has articles posted every day from the team, research team, opinions on the market, updates on the market, forecasts on the market. There's dashboards for refinery margins, for CFTC analysis, and beyond. So please be sure to check that one out. That's just launched last week. Okay, let us get straight into it then. Who's doing the start? Is that you, Vincent? Okay, give us a summary of what's been happening then.
Of course. So Brent Futures consolidated last week, actually climbed by $1 over the week, so surpassing $84 per barrel on Monday morning. That's this morning, so marking the first weekly gain in 3 weeks. Over the past week, actually over the weekend, the main headline was the death of Iranian President Ebrahim Raisi in a helicopter crash. They were actually coming back from Azerbaijan to inaugurate the Gizgalasi Dam. And of course, this underscores the geopolitical risk and tension in the region. Of course, the market has been rather numb to geopolitical developments in the Middle East recently, perhaps due to the spare capacity argument, and mostly are waiting for clarity following the OPEC Plus meeting in June. The death of the Iranian president is unlikely to change Iranian policy regarding crude exports. Meanwhile, over the past weekend, Ukraine also launched further drone attacks on Russia, so triggering a fire on Rosneft's Tuapse oil refinery on the Black Sea coast, forcing an emergency shutdown. Drone attacks also damaged the Slavyansk oil refinery in the Krasnodar region. So overall, we said that 102 Ukrainian drones were destroyed by the Russian military, and marks one of the largest Ukrainian drone attacks against Russia to date. Of course, the CFTC data has confirmed what we may have speculated over the past about the sell-off over the past weeks. So money managers continue to liquidate long positions from Brent Futures, 13% decline week on week. It has all the hallmarks of a de-risking market. The traders, speculative players, were not willing to commit to their bullish view. That was on the back of weakening macroeconomic sentiment and waning geopolitical risk. And as a result, a lot of the weak nervous length have been flushed out, creating more capacity for a new length to come in before the summertime.
Okay. So I think the big story at the moment, it's like a tale of two markets at the moment. So you've got the flat price that's actually held up quite well, if anything performed, as you said, and then there's the underlying market, the oil swaps market. So we have Brent time spreads like severely weakening relative to the back end time spreads. There seems to be a lot going on, and also in the oil swaps market that obviously we'll get into, refinery margins, dated Brent, or there's just a lot moving and shaking. But I think the time spread analysis first, the front fly being very, very negative. I think it's about minus 15. You could be responsible for a few things, right? Again, the money manager sell-off that you're talking about could also be in the front spreads, that hedge funds speculate in time spreads as well. That could very clearly be the case, but we also have had a weak dated Brent market. We've also had a very long dated Brent market, and these two markets are very linked. So it's not that surprising and on trend, but at the same time, when you see such a kink in back end buying essentially, because if there's front spread selling and flat prices rallying, then effectively it's back end buying. I think you could define it like that. And the back end time spreads are looking very strong. You've got like a very odd looking curve. There's probably a lot of big hedging going on, would be one interesting kind of take from it. I think there's a fair amount of movement of positionings that looks like it's actually ended, if anything. So we can't really look into, that's the annoying thing about the CFTC report. It's got a swap dealer section, and it's got producer, end user, merchant section, which is just like basically got the entire professional oil community within that section. So it's very hard to differentiate between what is hedging and what isn't. But I think that the evidence from the swaps market, at least, is that it's been actually, if anything, a little quiet on the physical side. So there's clearly some dominating position changes and or hedging that would be responsible for such a weird curve shape. You can't ignore it, is what I'm saying. It's very unlikely to be just the absence of flows and the curve does that. No, that's negative flies in the prompt and strong backwardation in the back. It's an odd one. So that's just worth pointing out. And then it seemed like the bearish narrative was building, and we got bullish US stats, we got bullish macroeconomic stats, and it has kind of saved the sentiment, if you like. But I think, again, it feels like whatever this selling has been, which could be, yes, decline of longs, of course, but I think also some producer hedging would be my guess. That seems to have, like, that volatility isn't there from that price action recently, and we're getting like small sell-offs in the morning and European time to like rallies in the afternoon. So I think the US market maintains a bullish outlook. The WTI Brent market is strong. The boxes are strong. WTI Brent versus deferred WTI Brent, that's a structure in itself, and that's strong. So I think tailor to markets, something, so as you stop this kind of not nonsensical flow, but something that's making things look a bit odd, then you could see things really kind of aggressively, like how do you call it? You're pressuring something down, not artificially, but because of some one-way flow, and then you relieve it. It can kind of all bounce back to quotation marks normality. So that could be interesting, and I think there's lots to say on the refinery margin market as well. But did we have anything else we wanted to add to that? Maybe on the CTA side.
I think the CTA link would be a good link into the refinery margins. This week we've seen kind of the fallout from that. The levels have dropped very low, and how each product has recovered has been really interesting, how they have recovered and like which have and which haven't. It may not surprise you to hear that according to the Onyx model, heating oil and gas oil is still very much the most negative out of everything. We've seen strength come back into EBOB and Gasoil, which has helped the products that we look at in the swaps market in Europe in particular see greater strength. So to look at that in a bit more detail, I think especially in gasoline, that's been really interesting. So the weakness, the most negative point in the CTA net positioning we saw in total was on the 15th of May, and this almost exactly lines up with when gasoline was at its weakest levels too. Rubber was at its weakest on, I think, the 14th of May, and then Europe, basically, the levels got so attractive that we had been seeing this trade house selling and selling into the spreads, but the levels got so low, I think we're about like $10 in the crack, that players were just really happy to kind of pile onto that. We saw really good buying from refiners and trade houses. The front spread saw about 5.5 million barrels of length put on by refiners in the past week, which is really impressive. And also refiners buying in cracks, which we always point to as quite like a bullish sign for the future ahead, as like kind of maybe unwinding hedges, looking for prices to go a bit further. I don't think that's really too surprising, as I think that if refiners were obviously hoping prices to go a bit higher than this. But yeah, that's in the first couple of tellers anyway. So that's kind of the correction from this really strong future sell-off that we saw last week. And we saw a fairly similar thing in gas oil too. Although it still remains very weak, we have seen a little bit of strength into gas oil this week. We saw it to highs of, just under $20 per barrel in the front crack, $19.90 this morning, but this got sold down to immediately. The front spreads are still the spreads are still in contango. Interestingly, from what you said earlier about the US market being such a key driver, we're seeing in the morning quite a decent amount of gas oil strength in both regions, especially Europe. But then the US opens and everything just gets smashed down. We're seeing this negative, pessimistic attitude coming from the States, and it's just kind of stymieing any growth we're going to be seeing into the future. I think spreads get a little bit of support from kind of like storage plays, but I think it's just looking pretty pessimistic. So
it could be its own refinery margin hedging, US focused refinery margin hedging, so bullish crude, bearish product. And it kind of would make sense if their refinery utilization is like really ramping up quite aggressively. So yeah, no, that's logical. Okay, interesting. I think we have to talk about dated Brent, right? I mean, ultimately, this is the benchmark. Of course, the introduction of WTI Midland it's happened for a while now, but it is incredibly volatile. And I think anecdotally, people said this, and I kind of thought, yeah, I mean, it's a new introduction of a benchmark, and it's a volatile market because we're in a very bullish environment, OPEC cuts, blah blah blah. But actually looking at it, especially in the last 2 months, like the diff's going to +2 to -1 to +2 again. No, it's crazy, and it shouldn't happen. So I think you're starting to talk about, and actually Jorge was talking earlier, as he tends to, about WTI Midland just destroying the Brent benchmark, that it's just too volatile, and there's a lot more need for stability. So in a way, he's kind of saying it hasn't worked, this move. It's unlikely to be unraveled, but if the new normal is volatility in the physical differentials, that's very hard to plan with, right? I mean, that's really difficult for refiners to manage their hedging profile, right? And that's what it exists for. Suddenly you're buying refinery margins with a +2 backwardation, and then to a -1 within a week, and then back up again. Like, no market should, unless something material has shifted in the physical, that shouldn't happen. You're talking about a few cargoes being left over from expiry last month, and market propping itself up, and then suddenly giving way after 3 or 4 strong expiries. Fine. But then it's still, dated Dubai is -50, which is like incredible economics to take the North Sea market oil east. Refinery margins are looking really strong again. So what I'm essentially saying is, there might have been a softening to the overall refinery margins and market outlook, and maybe starting to change, but it shouldn't cause that much of a volatile move on the physical differentials, because you're going from max bullish, like hyper bullish market, to hyper bearish, and back again. And that is a benchmark that I think you have to start blaming it and saying, but it shouldn't be allowed to happen both ways. If anything, you go, right, it's flip bearish, start to sell everything. You can't just constantly roll down so negative and then go so bid again. How are you meant to trade that? But I think actually, funnily enough, people are doing relatively well out of the differentials, because trade houses tend to be bullish. They tend to buy into CFDs, obviously in bullish markets, and they have performed quite aggressively to the upside in the last couple of years. But still, that's not what they're there for, right? They're there for hedging. So just wanted to point that out. Whether or not that's the reason why time spreads are doing what they're doing, I don't think so. I think if anything, time spreads have actually been less volatile and more reflective of what's going on. Like, to have a backwardated market, but the spreads being towards the lower side of backwardation, that's fine, right? That's just a generally relatively weaker market. But it would be the equivalent of dated as like the front 2 spreads being -1, and then the next 2 spreads after that being +50. That's kind of what's going on in the swaps market, which is just silly. Like, it's not reflective. Anyway, go on about it. But and the refinery margins situation, we're saying now, I was having a look at it, Asia's now heavily discounted to Europe. That's correct, isn't it? And that's got to be I don't know if we have the historical numbers, but that's got to be the first time in a long time. Again, showing you that the Dubai strength is holding really well in the crude market. So that's, relatively speaking, weakening the refinery margin there. And the volatility in data Brent is kind of opening up the margin in Europe. So it's yet another sign of dislocation. But generally speaking, can we say, despite all this weakness, CTAs, declining of hedge fund longs, sentiment shifting X, Y, and Z, it's still, to me, looking like a bullish market objectively in the numbers. Is that fair to say?
I think objectively, looking at flat price, that's pretty fair to say. $80, on a notional level, that's still pretty high, and also matches. Suppose it's also a level that OPEC would be relatively happy with. On an outright basis, of course, we're just looking at the physical differentials, which
the stocks are drawing again in the US. Macro sentiment's looking okay. Refinery margins back to strong positive in Europe. This is all bullish signs, right? And I'm sure, James, you're going to talk to us through the macro in a second. But do you see what I mean? Objectively, we shouldn't have so much volatility when the market hasn't shifted to like a net bearish. The only market that we can probably say has struggled a lot, like materially, is Gasoil. And as you say, Martha, like the US being attributed to that as well, but it's a global thing, right? The stocks are building, there's contango spreads justifiably, and there's weakening selling. That's reasonable, but I think overall things still look strong. So I'm trying to paint a picture of disorder. That's what I'm trying to push.
So we could expect a bit of a lead lag
situation.
Effect.
Agreed. Yeah. Okay. So to help build us a picture then going forward, James, what's the deal with macro?
Well, the good news last week was some economic growth, economic strength in China. The flip side of that, weak retail sales in China. In the US, though, the data continues to come in weaker than expected, unfortunately. CPI came in on expectations, and that was good for the market in the market was fearing higher numbers. So inflation coming in CPI 3.4% on expectations means CPI is actually falling again. But on that day, Wednesday and then Thursday, you had much weaker than expected retail sales and industrial production. So we have a picture here, a chart of the Conference Board's leading economic index. And you can see that's, it's been in contraction now for 22 months. And what it looks like now is the data is beginning to line up with that. Employment certainly getting worse. Retail sales is weakening. Consumer sentiment's weakening. So that's not a good sign. The OIS is still pricing, though, just 44 basis points of cuts this year. But yields are coming lower, and the concerns are starting to grow that the Fed may have to cut sooner and faster.
I feel like it's just constantly one way. Like one time we're talking bullish, and then we're talking bearish with the macro situation in US.
I think the big turning point really is employment.
Yeah.
And when employment starts to move one direction, it's
hard to unravel it.
Yeah, it trends.
Yeah, it trends. Yeah.
And that's the leader of the economy. But the other thing with what we're seeing last week is other commodities. If we look at the metals, gold's making all-time highs, copper's making all-time highs. Silver, we discussed the level at 30. It broke through that on Friday, and then this morning at one point it was trading limit up at $32.50. And the target for that's 40.
Was that a temporary limit up?
Yes.
Yeah. Okay.
Copper was limit up briefly. Zinc. What else was up this morning? Nickel, tin, aluminium. They're all much aggressively higher. Even orange juice is making all-time highs.
And cocoa, I guess, still strong from the past.
Yeah. So the other chart we discussed a couple of months back, the Bloomberg Commodity Index divided by tech stocks, the Nasdaq. Is it or isn't it bottoming? To me, it looks like that's clearly bottoming.
So bullish oil on the back of that. So oil's kind of lagging the rest of the commodities, it would seem, actually, now.
I would say the one problem with oil is I'll be slightly bearish on the economic data because economic growth is slowing, and the US is a quarter of global GDP.
But there's this narrative, isn't there, about copper, gold in particular, and silver now, I guess. It's protection against inflation with the renewable narrative and the new world we're going to see in the next decades to come. It's hard to argue with that. There's going to be a need for all these. So there's some opportunistic squeezes ahead of time, effectively. For that to, I'd love to see a chart of all these moving together with oil historically and what. And
that's exactly what I was just thinking.
Right.
Yeah.
I'm sorry, but to me, that's just the theme of this podcast, right? Oil is just something funky is going on that, to me, feels flow-led. That's not typical because there's a lot of people who would be trading off typical trends that would be either, to be honest, even having gotten very bearish oil like in the previous weeks, haven't been as bearish and then not as bullish now. It's stuck in this flow kind of constriction, which it's just, that seems to be what's going, because everything else is so the narrative has been commodities need to go higher. There's even the inequality argument about the rich having a lot more cash and assets are going to need to go up as macroeconomic data gets worse, right? As in they're going to put their cash somewhere. They're not going to believe as much in the dollar, treasuries, as things failing, so buy assets. So that's been a theme as well. Renewables, inflation, and rich people buying shit. That all together has worked out in terms of being reflected in commodity prices, apart from oil.
All apart from oil.
So, yeah, interesting. Okay. Googling oil then, the key one, I think Vincent, you already said about the Iranian president dying. We think, well, there was a rally this morning that's kind of dissipated. I mean, are people going to buy on the back of that? I don't know. I mean, it's not insignificant in terms of its impact geopolitically because of Iran's, what it's dealing with is with its own kind of civil situation. So generally speaking, we're told anyway, unrest. But I don't know. Obviously, I'm no expert in Iranian politics, but of course, with the sanctions, with nuclear situation with Israel, it's going to be interesting because I guess this is when this kind of change in leadership happens, it's going to be put to the test. The political party is going to be put to the test as foreign internationals try and maybe bargain for something new, especially the nuclear situation. So I could see people opportunistically. When I say people, governments opportunistically using this as a time to renegotiate things, maybe, and that kind of thing. Maybe there's an impact on the oil market, on exports off the back of it. You just don't know, right? I mean, things can change on a sixpence. So that's probably the significance to oil markets there. What else has happened? Googling oil.
So in terms of looking at elections in the States, we've got the Citizens for Responsibility and Ethics in Washington, CREW, are investigating a recent dinner at Mar-a-Lago where Trump allegedly solicited $1 billion in campaign contributions from over 20 oil and gas company executives. So basically promising to undo all of Biden's economic regulations in return. I think thinking about, especially I think what's really massive in the news right now is these LNG export development bans. People are that's just really not gone down very well at all in the industry and like in the public eye, I think, for a lot of people. The fossil fuel industry has been quoted to have donated around $7.3 million to the Trump campaign this cycle.
And what's the other part to this? The Federal Trade Commission accusing Scott Sheffield of trying to collude with OPEC to drive up oil prices.
Yeah, this was from last week, I think, actually. There's been a wave of class action lawsuits across the industry, the shale industry, last Monday in District Court in New Mexico. So in terms of company names, we're looking at Exxon, Oxy, Diamondback, at least 10 class action lawsuits alleging they've conspired to coordinate and constrain shale oil production to drive up prices, of course. Accused Scott Sheffield, that's the big name, former boss of Pioneer, to collude with OPEC specifically. I mean, they're pretty big. That's a pretty significant...
It's a massive accusation.
Yeah.
Like, how are you meant to even do that? I think the one thing I'll say about Scott Sheffield and the Shell situation, they've been like pretty damn transparent. Like, we're bullish. I think he was the guy that in 2016, the price was going below 40 again. He was like, I'm bullish, but as opposed to me just saying it, he's like, I've unwound all my hedges. So he was obviously had big shorts on. He just got rid of them. He was like, yeah, I'm now long physical oil. And actually in 2021 and leading up to 2022, why we had such a contribution to the factor of why we had such an overextended long market was because the shale oil guys didn't hedge. And they were saying, why would we hedge? You've got banks all forecasting, like JP Morgan saying $380 oil, your Goldman saying 200, most people saying at least above 100. Why would we sell as a hedge? Like, it's just stupid. So by them not hedging, meaning the market was starved of sell side flow, which kind of exacerbated the long market by implication. But they were very clear about it. And also, I don't understand how you saying, and they were clear about, we're trying to maximize shareholders' return. The only thing I thought was weird was the opposite. Is I thought, how can, like, US shale production kept increasing when everyone said it was going to level off, and all the evidence was suggesting it. And we were on this podcast, I remember saying it pretty much every week, being like, why does everyone believe that US production is just a media narrative? It's the opposite. Production is going up, and especially from the private companies, they are ramping up as hard as they can. When the price is above break even, no one's going to stop people from, like, it's like a refinery margin. It's either negative or it's positive, and when it's positive, you run at 100%. So it was actually the opposite. They were producing loads and as much as they could. And it was just a narrative that it was shareholders' return. If that's what they're complaining about, you're saying one thing in the media, but actually you were producing more. That, I think, is a bit more believable, at least from my point of view. But I don't know anything about this. I just heard it. But that's an incredible accusation to say that they were reducing production to support OPEC, because that's complete bollocks. It's been increasing production non-stop. I don't know where people get these ideas from.
I mean, it would be definitely worth a deep dive into seeing what the actual case of the suits are.
I'd love to, yeah.
And the evidence, but I don't know
Cool.
how classified it is.
No, that's a really good one. So, I mean, what are the implications there? I mean, we've got certainly, it's just more confirmation that if Trump gets into power, obviously he's definitely going to support but I don't get what he needs to support again. If they're already maximizing their production, maybe there's something. I
think he just wants cold hard cash to fund the campaign. Like I know
his side, but I'm saying
right.
for them, they've already got what they need, from my understanding. Biden's support, if anything, they came out. Who was the woman that came out and said we're gonna?
Jennifer Graham.
Jennifer Graham. She said like one of her pitches was like we're supporting oil and gas now to get rid of it in the future. In other words, like you can convert all your free, like your licenses for producing oil, you can convert it to hydrogen production or something like that. In other words, they weren't going to make it like hard to or penalize you for what you've got. So at the end of the day, I'm not really sure what they would gain. Maybe just a generally friendlier administration suits them. But
even the Inflation Reduction Act, that was like touted as being a massive like con for the oil and gas, but they were given so many extra avenues to make profit through that, like with the carbon credits and with the offshore drilling having to be auctioned to them first before it can be wind farms, for example. Like there was never that kick in the teeth that the media kind of portrayed the Inflation Reduction Act to be.
Yeah. No, interesting. Okay.
Some recent ones actually. Some headlines about the oil industry. It's a very tentative relationship with Biden. Yes, they've had record profits under his administration, but then there's also about the Biden administration suspending new licenses for LNG terminals, also like restricting offshore drilling leases in the Gulf of Mexico, and also the administration's push towards the energy transition as well. So it's a very uneasy relationship in the fact that, at least with Trump, he's always going to be pro fossil fuels, oil and gas, but with Biden, he can do a 180 any time, which fosters a lot of uncertainty.
Understood, yeah. And then for us, I mean, I think the big thing with the election was actually the impact on oil was the trade war. So Biden's jumped ahead and put a 100% tariff on EV vehicles, which I was learning a bit more about how the Chinese are circumnavigating that, have been circumnavigating that via Mexico. But either way, they're kind of it's a good move because it kind of takes from Trump's playbook. And he said, that's nothing, I'll do 200%, but whatever. But for us, that's quite a big deal because you got all the arbitrage contracts that would materially shift from 2024 to 2025, which 2025 has been traded quite actively, especially propane markets. You've got WTI Brent markets. So WTI Brent showing the movement of US to Europe, and then you could add on to that to Asia. So that differential in a trade war would, I guess you'd have to look at it WTI versus the Dubai benchmark, and that would widen significantly, right? US not being able to export to China, to Asia, so that would have an impact. But I think more materially, it's more because Chinese buy more Middle Eastern and Russian anyway, so it's probably more on the products. So LPG, the trade war there, that would be very bearish. The arbitrage, LST versus FEI. And there's probably more, right? There's probably East-West contracts that would probably strengthen on the back of an aggressive trade war. But that looks like it's going to happen with Biden or Trump. So I can't see specifically how this shale oil situation changes, other than maybe more consolidation. That might be something that Biden's against, proving mergers and acquisitions in the shale oil field. But again, that's a leap. So probably leave it there, but it's still interesting nonetheless. And is that it really for the headlines? Nothing else? And James, anything headline wise you think we should be looking out for?
No, really. The key data this week is pretty quiet in the US, but an interesting one in the UK. Inflation CPI last month was 3.2%. It's stated to come in at 2.1%, which is a massive fall. Yeah. Base effect's rolling off, but the Bank of England's target's 2%. So if it comes in at or a fraction above,
guaranteed rate cut,
they're going to be cutting sooner and harder.
How do they have to wait until all these scheduled meetings to cut rates?
They don't have to, but normally that's only an emergency. Typically, if that happens, I remember it happening back in 2000 when the Fed suddenly cut into meeting. You panic the market. The market said there's something up. They've had to go between meetings. So I don't expect they would need to go outside of a meeting. And we got the ECB 100% expected to cut now on the 6th of June.
And when's the UK one?
It will be within 2 weeks of that.
Okay, June, the key month then. So we've got June, we're starting to trade summer contracts. And we've talked about a lot how invested the oil market is on the long side to those contracts and how bullish the market is in summer. Couple that with a macro situation, June to the Europeans cutting, which is definitely an impact on the economy, right? And then still a bit shaky on US. So yeah, plenty to be interested by. And in the meantime, what does that do to the current silver gold situation? Europe cutting rates.
I think basically we're just going to see more sentiment moving towards that. The data came out last week highlighting how the China's sold US treasuries and agency bonds. We know central banks are buying these products. We know retail are buying them. It just seems to me early days it's getting more and more discussion in the press. And these aren't short-term trades. When central banks diversify their portfolios, that's a permanent move.
Interesting. So more kind of pushing what's already happening. Yeah. Okay. Cool. Trade idea for the week, guys. Is that you?
Yes, that's me. So we're gonna go. The idea is to go long the June-July DFL roll. So that's in the North Sea dated Brent crude market. So DFL dated Brent versus Brent swaps, reflection of the underlying North Sea physical market. Of course, the chart would show that the past few weeks have been extremely bullish for the dated market, as we have discussed before, and we're expecting a mean reversion over here. So to put it more technically, weakness in data structure, the physical selling had filtered into June, and especially in the June-July DFL roll, that's bottomed out at around minus 35 cents per barrel, which is extremely weak, oversold on technical basis, and with physical so weak, we don't expect much downside at these levels. It's quite volatile. It goes down pretty quickly, and it could go up just as quickly as well. Some fundamentals factors do support this. Of course, you have improving refinery margins, a macro picture. Of course, the weaker dated Dubai automatically provides an outlet for 40s crude to move towards East Asia, so there might be more demand there. The Wink to Webster pipeline in the US is scheduled to have maintenance over the coming weeks, so that might reduce crude exports out of the US. WTI Brent spread has been correcting higher these days as well, so that might lead to less exports to the North Sea. And so therefore, if the physical was to recover, we can expect an orderly roll up, and this roll June-July would capture the mean reversion quite well.
Yeah, it's really well thought out trade. I think this is a classic example for me. Like, assuming you're fresh into the market and not having war on the downside, it's all been a bit of a calamity in the front, like we were talking about at the beginning. So if you are still bullish and you're wanting to re-enter, or you're wanting to enter a fresh trade, you want your hypothesis, and I think if it is simply just bullish crude refinery margins, supply and demand into summer, fine. What is the cheapest thing on the board then, and what is the most highly attractive from a risk reward perspective? And the DFL roll is a great one because, one, I would say systematically M1 M2 DFL roll tends to be more bullish than it is bearish. The reason being, right, so you've got a dated component and a Brent spread component in there, right? So you're long a dated Brent spread, which is very correlated to a Brent spread, but then you're shorting the Brent spread against it. So what are you trading there? And as you said, you're trading the dated to lead. So the convergence of the physical dated Brent barrels versus the Brent future. So it's a very technical expiry based trade, and they should really be equal to each other, but it's because of the nature of the loadings and definitely can't go into it right now, but it's a technicality. But yeah, the data to lead being about minus 35, that in recent terms is towards the low side. In a kind of normal markets, if you like, at the moment, minus 10 seems to be about right. So it's been very volatile in between that, but you've got that supporting you. So a natural kind of convergence as you get towards expiry. You've also had a massive washout on the front that has led to differentials being the lowest since, I think you guys said 2020, which is fucking huge. In a bullish market, you're getting 2020 level pricing or level diffs. So you've got that to buy on the floor of, if you like. Plus, if the market moves down continuously on Brent, flat price and spreads, you don't have that exposure. You're not exposed to the beta of Brent weakening. If anything, Brent spreads being weaker might actually help the DFL roll converge. So it's a really you could get super technical about all this, but I like it because there's a few different components to it. And at the end of the day, it's a low price. Minus 30-ish on a DFL roll in a bullish market is very, very weak. So that's a good one. And I guess you've picked it up. Minus 31 is where it is right now. The floor was what, around minus 38-ish, 40?
Around that, yeah.
Around that. So I wouldn't quite call it a trending trade yet, but I would say you've already had the pop-up. You've had a stability as things are looking like post-washout, if you like. So you would buy into this, and I would usually say when you're looking at a graph like this, it's been so like weak for so long and you're catching a reversal, that you would buy and scale in. But the thing is, with a DFL roll, it's an OTC traded market, right? So you mentioned like capturing that orderly move. When you used to trade DFL rolls, it would happen like in a day, and you wouldn't even notice it. It wouldn't like even be because someone traded it. It'd be like you get some kind of strength in the curve. You start trading the CFD rolls, and before you realize it, once you mark your curve, the DFL roll's up 10 cents. So you need to be in it to win it. It's one of those trades that as it's turned, you want to be in it with the volume that you want, high conviction, and kind of you'll realize that P&L when it moves like very aggressively. A bit of nuance into data, Brent there. You like that?
Yes. Very technical. Always
okay, cool. So last week's poll was what's the best buy right now? We said Brent Futures, GameStop, China long-term bonds, or copper. Oh, that's like probably one of the more tighter ones we've ever had, actually. So most GameStop just won it, which maybe people are cheekily saying, I don't know. And then 28% said copper, 23% said Brent Futures, and only 19% said China long-term bonds. What did you think about that?
Yeah, I was going to say, I wanted to interrupt actually. One thing we haven't touched on is equities, and we've got NASDAQ and S&P making new all-time highs. Volatility on Friday, the VIX closed its lowest level for 4 years. And we have NVIDIA earnings on Wednesday. Two interesting factors. Firstly, for 2 weeks running, we've seen funds with outflows in tech, which we've not seen for over a year. And the second point, a statistic I mentioned before, when the Fed start cutting rates, typically the S&P bottoms 6 months after the first Fed cut. And this is going back to 1970, whenever there's a recession. So everyone's buying now in anticipation of cuts, but when they start cutting, that's when equities typically sell off. So yes, the price action, it's just broken all-time highs and it's going higher, but we're getting towards the, 11th hour or last.
But you're talking about US, right?
Yeah, US.
So if US don't cut, then it's not, you don't have that argument, right? It's still possible.
If they don't cut, we see they're starting to strangle the economy. The economy is now slowing. All these rate hikes.
Right.
A year ago, economists perceived a recession on the fact that interest rates had gone so high, but there was no sign of the economy slowing. Now we can see unemployment ticking up. We can see from the retail sales across the board, the PMIs, the economy's slowing down. It's not at critical levels yet, but it's slowing. So I'm just saying the price action, commodities are going up that we're talking about, the precious metals, the metals, equities are going up. But typically, when the Fed start cutting, the yield curve steepens, and that's when equities start to fall.
I just propose, probably everyone who trades is always probably susceptible to thinking this time's different type thing. But is there not something to be said about this is the most accessible market we've ever had, right? Everyone being able to trade, and I want to say everyone, I mean literally anyone who's got access to the internet and a bit of cash can trade most markets these days, and therefore influencing most markets. And we've seen the impact of that on, people call them meme stops, but I think it's quite, it's funny to say it, but it's a bit condescending because they're not going anywhere, right? And actually more and more financial planners, these things are becoming so democratized. Everyone has access to trade the way they want to trade or invest the way they want to invest. And a lot of these historical correlations, it seems like we're very often talking about, they're on the extreme side. But could it just not be a whole new world? There is something to be said about that, right? There is a scenario where you could rate cut and equities do still rally, just pure the power of financial.
If the economy remains strong, at the end of the day, what are equities priced off? It's the profits.
Well, it's priced off people buying and selling. So people just keep buying because they're taking ownership of themselves. And you flick on YouTube Shorts or TikTok Shorts, assuming your algorithm hits you for personal investing, which has got to be most people or a lot of people, it's just everyone goes on about this. Just buy the S&P index. Just buy the S&P index. 8% average per year. if you started with 10 grand, you'd have 500 billion in 10 years or whatever it is, right? And it's like going back to the Warren Buffett thing all the time. Like, you know, he wouldn't even advise investing in his fund, you know, just buy the S&P index. So if you're getting that every day and that's all you ever hear, then by de facto, people all used to put their money into real estate. And now it's like, just put it into an index. It's very easily accessible, very liquid. That could change just the whole historical structure of charts, no? You don't believe that?
But there has become a point where it's expensive and the sellers come into the market. We've seen some of the big funds last week closing out their positions on Nvidia. And we've seen it with Zoom and Peloton and Palantir and Lucid and Rivian.
You're a stark believer in fundamentals.
I'm a stark believer in at some point
order.
It becomes expensive and the selling starts to outweigh the buying.
Yeah, exactly, yeah. But that's just a movement of flow and transfer of money. And I think if you...
And maybe it's led by an event. There's COVID.
Yeah.
Financial crisis.
Yeah. But what in a scenario if dollar does collapse, some people are predicting stock prices, asset prices have to continue to rise. And it might just blow historical norms because the dollar's the one that's screwed. You see what I mean? I don't know, probably everyone always thinks that this new, what's coming next is the new doomsday.
But also, I think the key point, I said, the price is still going up and it's just broken all-time highs. So what you've got, it's almost a free trade. You can buy with a stop loss just below the previous high.
Yeah, that's interesting.
And that's a trade you play.
That's a trade idea.
Price action is going up, but at some point it has to become expensive.
No, fair play. Okay, thank you very much, guys. A bit more animated discussion there, maybe just mainly from me, but thank you for listening. I just wanted to point out as well, we've got a new leadership podcast coming soon with Andrew Chen, who's our new CFO. Very transparent discussion, financial planning, evaluating businesses. Really enjoyed it, and I hope you will too. So please be sure to check that one out when it comes out. Thanks again for listening, and see you again soon.